Joining me now, Region's Chief Investment Officer, Alan McKnight, and Geltrude Company founder, the man himself, Dan Geltrude. Gentlemen, thank you both for being here. Alan, let me begin with you. Do you still have the sense that we have a bullish trend right now? There's a lot of, we know there's been a ton of money on the sidelines. I feel like the bullish trend is continuing. Would you agree?
We completely agree. We think that the trend is your friend right now, and the fact that we had such a momentum wave at the end of last year that has continued, but for good reason, because those names that have delivered from an earnings perspective, from a revenue growth perspective, are garnering more inflows, and they're supporting higher valuations. We think that can continue through the balance of the year, maybe not to the degree that we saw last year with the rally across the board in the S&P 500, but really driven by a few names. But as it broadens out, we think that the S&P can still do quite well this year.
Alan brings up a good point, Dan. You know, look, has the bullish trend been too concentrated? Is it just those few names, the Magnificent Seven? I mean, we've been saying this for years, that they've been carrying the weight. Is there signs of a more broad-based advance?
Well, there's no question about that the concentration has been there, Ash. I mean, all you have to do is look at the numbers. But if you go beyond that, you could absolutely see there are a number of gems out there, and you have to go searching. You have to go looking. Now, personally, I really like the energy companies. I always have. I like the profits, and I like those dividends. So to me, when you're looking at investing across the board, there's plenty of places to make money out there.
Very good. Alan, let me bring you in on the Fed. We have to talk about it because we'll be getting a Fed decision next week. We know they, well, we say we know, but very unlikely to do anything in March. Now the chances, I think, of a rate cut in June around 65%. You know, the data continues to suggest that the inflation is sticky. It's not coming down as much as the Fed would like. And of course, if they don't cut rates, isn't that bad for the markets?
Well, I think as long as the Fed remains consistent, they've been consistent in their communications over the past year. And I think maybe the market got a little bit over its skis, and investors, in terms of a belief that we were going to go out with significantly more cuts and the Fed was going to be behind that. But we think over the course of this year, as long as the Fed stays on its path, we do see a few cuts over the balance of the year, the market can still do quite well. And to Dan's good point earlier, we're seeing a broadening in the equity markets. We're seeing more names above their 50 and 200-day moving averages, almost 2/3 through the beginning of this year. And so I think they can live with the Fed being a little bit slower in terms of those cuts.
But Dan, if we get the PPI tomorrow night, also comes in hotter than expected. That always tends to hurt the market overall because it puts off those rate cuts even more. What are you expecting?
Well, you know, I expect the PPI is probably going to be slightly elevated. I certainly don't expect it to be down. At least that's my projection here. But I don't think we're going to see any movement that it's going to make a substantial difference to how the Fed is approaching interest rates right now. I think they're pretty set on this is going to be something that happens in the second half of this year. And I think the market is baking that in. So I'm not expecting too much on this, Ash.
Well, Alan, let me ask you this. What could upset the trend? If we believe that we are still definitely in a bullish frame of mind, the momentum is there, you can't fight it, but what could upset that, do you think?
I think, one, if we see a reversal in the trend we've seen in inflation, yes, it's slowly coming down, but if for some reason we were to see some type of exogenous shock that drives it significantly higher, which takes the Fed to a different place, I think that's problematic. I think when we come out in earnings season for the first quarter, if companies are really telegraphing that revenues are going to be lighter than expected while expenses remain elevated, I think that's problematic. And suddenly investors start to scratch their head and say, are we really going to pay these types of valuations and these multiples for earnings? So I think those two things could create a bit of a maelstrom in the market as it relates to the balance of the year.
Dan, we know you like oil. Very quickly, what areas are you avoiding in this environment?
Well, in terms of, I'd rather talk about what I'm looking forward to. And I specifically,
okay.
you know, I like oil, but I got to tell you, Targa Resources, that is a stock out there that has growing EBITDA, growing dividends, reducing share count, strong balance sheet. So I would really say that's something I really like out there right now.
Very good. Alan, Dan, thank you both for joining us. Lots of great information. It is much appreciated. Thank you, gentlemen. All right, breaking news.